discussion about the impact of the debt mutual fund taxation revision on the NBFC industry as well, because it is having a negative connotation given the fact that cost of funds is likely to go up. Let's discuss it more with Mr. Vivek Karve, the CFO at Mahindra Finance, to understand exactly what they expect as an impact of this decision. Vivek, hi, thank you so much for making time and speaking with ET now. I just wanted to begin by just that. What do you think will be the impact of this amendment with respect to the source as well as the cost of funds for NBFCs?
So I think it will be interesting to look at what is the population that we are talking about. So if you look at the debt mutual funds, the debt mutual fund category is about 12 lakh crore rupees. Now, in that category, if you were to look at those mutual funds who typically would invest, say, more than 3 years, say the more tenured papers, that would roughly be about 2 lakh crore rupees. And if you look at the overall mutual fund industry, that's about 39-40 lakh crore rupees. So it is important to understand whom are we talking about. So we are probably talking about a 2 lakh crore industry, which is more tenured papers, number one. If you look at various NBFCs like us, and if you look at our ALM, the ALM would be typically in the region of 25 months to 30 months. So that is how we would be borrowing from the market. So are we borrowing very long tenured papers from mutual fund industry? The answer is no. And therefore, I really doubt whether the flow of funds for NBFC in general and MMFSL in specific would get impacted to a very great extent. However, at the same time, there are news reports that say that because of this taxation on all mutual funds where the equity proportion is up to 35%, does it create a level playing field for some other sources, such as, say, a bank FD or an FD that some of the deposit-taking NBFCs would be raising? Probably the answer could be yes. To what extent, time will tell.
Sure, point taken. But Vivek, specifically for MMFSL, what's the exposure currently, let's say, to debt mutual funds? And are you expecting a big shift in your pie of the source of funds that you used to go to?
Yeah, I am not expecting a big shift, to be frank, because we have a very broad-based approach towards our borrowing. So there would be borrowing from the banks, there would be borrowing in the NCD market. Even in the NCD market, banks would be investors, insurance companies could be the investors, mutual funds could also be the investors. Then apart from this, we have securitization as a tool, we have fixed deposits as a tool. So not just us, but none of the NBFCs would be highly concentrated when it comes to borrowing through the debt market or the market borrowings from the mutual fund industry.
So, just to interject, isn't the exposure to debentures currently at 43%?
We are also, in our investor presentation, we also give some disclosure as to from where we are borrowing. So if you were to go to our Q3 presentation, in the Q3 presentation, we are saying, say, suppose 100 rupees is the total borrowing that we have. Only about 8.4% is the share of mutual funds as our borrowing source. How the banks and the various developmental institutions will constitute 56%. Insurance companies and pension funds cost about 18%. FIIs and corporates cost about, they contribute about 7%, and the others contribute about 10%. So the weightage of mutual funds as a source of borrowing for MMFSL is pretty moderate at about 8.8%, 8.4% as of 31st December.
Right. But the fact is that cost of funds is also, headed higher with the central bank rate actions. So how confident are you of sustaining your NIMs above 7%?
Again, a question of crystal ball gazing you are asking me, but let me make an attempt. So Fed, as you know, has already increased the Fed rate by another 25 basis points. My belief is that RBI may follow suit by doing a commensurate increase in the repo rate by another 25 basis points. However, given that the world at large is looking at a recession, whether, and especially in the US when there is so much of uncertainty, there could be a halt on this rate increases going forward, which means at some stage the rate increases will stop. And if the monetary measure of increasing the repo rate and therefore moderating the demand succeed, then especially at the shorter end of the curve, the rates may moderate. I'm not expecting that moderation to happen anytime in the first half of the coming year. It may moderate towards the second half of FY 23-24. But very difficult question to answer, to be very frank with you.
NIMs will be 7% above, and you will be able to pass on the rate hikes to customer when it comes to the disbursement?
So Fed, as you know, has already increased the Fed rate by another 25 basis point. My belief is that RBI may follow suit by doing a commensurate increase in the repo rate by another 25 basis point. However, given that the world at large is looking at a recession, whether and especially in the US when there is so much of uncertainty, there could be a halt on this rate increases going forward, which means at some stage the rate increases will stop. And if the monetary measure of increasing the repo rate and therefore moderating the demand succeed, then especially at the shorter end of the curve, the rates may moderate. I'm not expecting that moderation to happen anytime in the first half of the coming year. It may moderate towards the second half of FY 23-24. But very difficult question to answer, to be very frank with you.
So what about your asset quality? Gross NPAs have been trending lower and sub 6%. Is the trend here, and is it likely to continue?
You're right. I think there has been a very concerted effort to bring the NPA down by diversifying the asset base as well as intensifying the collection efforts and using all the necessary legal avenues that are available to provide more effectiveness to the collection machinery. And those have been yielding very good results. So you would have observed that on a sequential basis, the asset quality has been improving. And our attempt will be to sustain this asset quality as we look at entering the new year, which is FY 23-24. And to your specific question, whether we are seeing any pressure on asset quality as we speak, the answer is no.
So since you're talking about the guidance, your guidance for return on asset was also around 2.5% by FY25. You're on track for that?
Yeah, I think that's been our aspiration and we will work very hard towards it. As you would note, for the first 9 months of the current year, we were able to deliver an post-tax ROA of 2.1%.
Okay, Vivek, we'll let you go on that note. Thank you so much for joining us with that perspective of how this amendment is likely to play out for the NBFC sector as a whole and MMFL specifically.